Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Apollo Commercial Real Estate Finance, Inc. Annual Report. Apollo Commercial Real Estate Finance, Inc. offers a range of commercial real estate-related services and investments. The company originates, acquires, and manages commercial first mortgage loans, which are essential for businesses to secure funding for their properties. In addition to mortgage loans, Apollo Commercial also provides subordinate financings, which offer additional financial support to borrowers who may not qualify for traditional financing options. This service caters to a broader range of clients, including those with less than perfect credit or smaller budgets. The company's services and investments are not limited to lending alone. It also invests in other commercial real estate-related debt investments, which provide opportunities for diversification and growth. By offering these various services and investments, Apollo Commercial Real Estate Finance, Inc. has established itself as a comprehensive provider of commercial real estate financing solutions. The company's business model is designed to be tax-efficient, taking advantage of the REIT, Real Estate Investment Trust, status that allows it to distribute at least 90% of its taxable income to shareholders and avoid federal income taxes. This structure enables Apollo Commercial Real Estate Finance, Inc. to maintain a competitive edge in the market while providing attractive returns to its investors. Overall, Apollo Commercial Real Estate Finance, Inc.'s services and investments cater to the diverse needs of commercial real estate borrowers and investors, making it a significant player in the industry. The stock price of Apollo Commercial Real Estate Finance, Inc., ARI, has seen a significant increase of approximately 24.99% over the past year due to several key events and positive financial indicators. One major factor contributing to this growth is the sale of ARI's commercial real estate loan portfolio for $9 billion to Athene Holding Limited. This transaction not only generated substantial net cash and common stockholders' equity, but also validated ARI's book value, providing a 23% premium to recent stock trading levels. In addition to the sale, ARI's strong Q3 2025 earnings performance exceeded expectations, with a reported EPS of $0.30 against a forecasted $0.25. This positive surprise has boosted investor confidence in the company's financial health and prospects for future growth. Analysts have also played a significant role in driving up the stock price, with J.P. Morgan naming ARI as one of their top income stock picks for 2026. The analysts' overweight rating and increased price target from $10.50 to $11 further support this positive sentiment. Furthermore, ARI's consistent dividend payments over the past 16 years have provided a robust yield of 9.88% as of January 28, 2026. Expectations that earnings per share will exceed dividend levels by the end of 2025 suggest a potential dividend increase in 2026, which could further boost investor interest and drive up the stock price. Overall, the combination of these factors has contributed to ARI's impressive stock price growth over the past year, making it an attractive investment opportunity for those seeking strong income returns. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's financial performance over time. Revenue growth is primarily driven by increases in net interest income, which rose by $49,190 from 2023 to 2024, and by $21.93% from 2023 to 2025. Additionally, revenue from real estate-owned operations remained relatively stable, with a slight increase of $208 from 2024 to 2025. The company also experienced significant income from equity method investments, totaling $15.4 million. On the other hand, revenue decline is primarily attributed to decreases in net interest income, which dropped by $32.3 million due to lower average index rates and realization of a loss on investment. Furthermore, net income related to real estate owned decreased by $2.8 million due to an increase in operating expenses. The gain on foreign currency forward contracts also decreased by $151.3 million. Overall, the company's revenue growth or decline is largely influenced by changes in interest rates and investment performance, as well as operational expenses. The analysis of net income and profit margins reveals a mixed picture over the 3-year period from 2023 to 2025. In 2025, compared to 2024, net income increased by $246.4 million, indicating an improvement in financial performance. However, when comparing 2025 to 2023, net income only rose by $58.6 million, suggesting a slower growth rate. Profit margins also underwent changes during this period. In 2025 compared to 2024, profit margins likely improved due to reduced operating expenses and increased other income. Conversely, in 2025 compared to 2024, profit margins decreased due to significant realized losses on investments, partially offset by gains from litigation settlements. The reasons behind these changes are multifaceted. Realized losses on investments and gains from litigation settlements had a substantial impact on net income and profit margins in both years. Additionally, equity-based compensation expenses decreased by $2,837 from 2024 to 2025, while loss-gain on foreign currency forwards increased by $151,293 during the same period. The profit margin ratios provide further insight into the company's financial performance. Net interest income as a percentage of total net revenue declined from 73.2% in 2023 to 62.1% in 2025, while total net income as a percentage of total net revenue improved from -43.7% in 2024 to 42.1% in 2025. These changes suggest that the company is shifting its focus towards more stable and profitable business areas. The company's financial performance is a crucial indicator of its overall health and stability. In the year 2025, the company achieved a significant milestone by generating positive operating cash flow. This means that the company was able to generate more cash from its core operations than it spent on various expenses. According to the financial report, the company's operating cash flow for 2025 was $1,064,968, which is a positive figure. This indicates that the company has been successful in managing its finances effectively and generating sufficient cash to meet its operational needs. The generation of positive operating cash flow is a key indicator of a company's financial health and stability, and it suggests that the company is on a solid footing for future growth and development. The management of this company is emphasizing a cautious approach to risk management, focusing on credit quality, interest rates, liquidity, prepayment speeds, and market value. This is evident in their strategy to achieve attractive risk-adjusted returns through the use of leverage, with a goal of 2 to 3 turns of leverage. The company's commitment to tax qualification as a real estate investment trust, REIT, is also a key aspect of its strategy. To maintain this status, they must distribute at least 90% of their taxable income and plan to pay dividends equal to net taxable income if authorized by the board of directors. In terms of investment focus, the company prioritizes institutional quality real estate in the U.S. and Europe, targeting assets with high credit quality. They have a dedicated team of asset management professionals who actively manage assets on an ongoing basis, adhering to strict investment guidelines that limit investments in any single asset to 20% of net equity. While the company appears to be managing risks effectively, there are some areas for concern. The decrease in net interest income and increase in credit provisions may indicate potential challenges ahead. Additionally, macroeconomic conditions affecting commercial real estate markets and global capital markets could impact the company's ability to meet debt covenants. The company has made several acquisitions and divestitures over the years. In terms of acquisitions, the company has purchased various types of commercial mortgage loans, including whole loans, B-notes, mezzanine loans, and asset sales. Additionally, the company acquired several properties through deed in lieu of foreclosure, including a hotel in D.C., a multifamily development in Brooklyn, and an Atlanta hotel. The company also entered into a proposed transaction with Athene, which involves purchasing loans from the company. Furthermore, the company has made alternative acquisitions, such as acquiring assets through a superior proposal. On the other hand, the company has divested several properties and loan interests. This includes selling commercial mortgage loans secured by various properties in Europe and London, as well as a partial interest in a mixed-use property in London. The company also sold loans to Athene, excluding 2 specific loans with a combined total principal balance of $146 million. In addition to these transactions, the company has made asset sales and held certain real estate assets for sale. Furthermore, the company has securitized or sold loans through a trust residual structure, TRS, to avoid prohibited transactions tax. The company has a history of paying dividends to its shareholders. This is explicitly stated on page 7, where it is noted that dividends, yes. Furthermore, the intention to distribute net income to stockholders in accordance with the REIT 90% distribution requirement, as mentioned on page 33, reinforces this point. While there is no clear information regarding share buybacks, the company's commitment to dividend payments suggests a focus on returning value to its shareholders through this means. That concludes the financial summary for Apollo Commercial Real Estate Finance, Inc. Feel free to comment below, and I will be happy to answer them when possible.